Good morning, everybody. You all will be surprised now that there is going to be another 4 products going to be introduced over the next 6 weeks. So there is lots that we are going to be. This is going to be the Gyan month, so to call it. Excited to be presenting these over the next weekend. Month and a half. And I'm going to. I think it's 11:01. Let's begin today's webinar. As we all know, today's webinar is understanding Specialized Investments Fund and everything there is to know about it. So let's begin right away. I will begin sharing my screen with you all. Those of you who've very courteously have your video shared on, thank you very much. Give me a show of hands if you see, if you're able to, if my screen is visible to you all. Yeah. Thank you very much. Awesome. Let's begin and give me a minute. Let me do a few settings here. All right, excellent. Some of you would have known, those of you who've been working with us for a long while now, you'll see that there's a slight change in format, and that is very intentional because of everything that we're going to be doing going forward from this financial year onwards, right? So for the best experience, this is for your best experience as audience for the webinar. Please attend this via laptop or a tab. Don't attend this from a phone for more reasons than one, because I'm going to be sharing my screen with a few important details. So it will be best consumed when you attend the webinar via laptop or your tablet. Next, please mute your lines if you have nothing to contribute. If you're in an environment that has got external disciplines, please have your lines muted at all point in times. Needless to mention, I think this is something that I sound like a broken record every webinar. Please have your videos turned on so that it, encourages me to look at different expressions and understand whether you're following, not following, overhead transmission, and all of those other experiences, right? Last but not the least, from this time on, let us have all our questions documented in the chat box only. I am not going to be looking at the chat box. We will be looking at to the very end. Basis everything that I've got, so all the feedback that I've got from you guys so far, I made it a point to make it, have all possible clarifications clarified during the course of the webinar itself, right? So please have the questions or clarifications, queries, whatever it is, in the chat box, and we'll address it towards the very end. Last but not the least, this is for my best experience in terms of delivering a good experience to you all. Let's be very engaging, okay? I am going to be asking a lot of questions, show of hands, emojis, whatever it is. Preferably, please unmute your lines and respond to it so that there is, a two-way conversation, as against a lecturer giving, that boring lecture on a Sunday when you're forced to come and attend class. So I hope you'll get it. I need you all to know it's a very, very boring topic, too much of gyan, and I'm trying to do my best to keep it as simplified as possible so that we not just understand this, but also take meaningful action after we've got through understanding how this works for us. All right. Having said that, quick disclaimers, everybody. The purpose of this webinar is from an education standpoint only. It is not a product pitch. Obviously, if it suits your risk appetite, if it suits your liquidity, if it suits your goal aspirations, or whatever those parameters are, only then we consider this. But for today, the webinar's purpose is from an education standpoint. Next, I am not planning to make you all, experts in this product. It is for understanding purposes from a simplicity standpoint and not getting into the technicalities of it. Everything that we're going to be covering as far as data points or whatever it is from numbers, it's based on, as of today, which is the 7th of March, 2026. Any changes that is going to happen henceforth, or if it's not updated here, please get yourself up to date basis when you're going to be consuming these data points. Please understand, the recommendations that I'm going to be giving you is basis the risk framework that we follow at MishMash Finserve, and not some random ad hoc strategy that is meant one size fits all for a YouTube audience. That's not the purpose. Last but not the least, if you are not if you're not a customer, which means we don't have a working engagement just as yet, please note that before you make any specific investments, just because you like the content of this webinar, it is designed in a manner very specifically to for folks who are used to our style of working. If you are not a customer just as yet, it would be best that you do your own due diligence, do as much of research as you can do so that it matches your risk profile and your life stage or your life situation. Having said that, very quickly, let's understand our current options. And here, ladies and gentlemen, I need your participation. And please let me know if y'all are in a position to see a nifty chart over here. If yes, super. Thank you very much, Nakul. With that said, ladies and gentlemen, this is September 2024. This is one of the most recent lifetime highs that the Nifty had done. Nifty 50. I'm sure dozen of you all have already gone through this multiple times, so I'm not going to get into the specifics of what and how. But this is where Nifty made a lifetime high, and as we can see, this is September of 2024. So those of you who would have invested a lump sum money right now, okay, and after 15 months, are we in the positive? Are we in the negative? Folks, you can either unmute
Sorry,
your
what's the
lines.
question, Sharath?
Interesting. All right. The question one more time. If I would have invested my money, let's say if I had invested 10 lakh rupees out here, September 2024, not 2025. Today, this is the 6th of February. Am I in profits? Am I in loss?
We are in loss. I mean,
Very nice.
yeah.
Hindsight is 2020. Now, over here, am I in profits? Am I in losses? Instead of 15 or 16 months, now let's say we are just at about 12 months. Am I in profits? Am I in losses?
Still in loss, yeah.
Zero, no gains, no losses. For those of you thinking, hey, you know what, Sharath, this is elementary stuff. We go through this on our ongoing. Stay with me. There is a very specific reason why I'm pointing this out. All right. The age-old question: do I invest lump sum? Do I invest in SIPs? So over here, for all the tenured investors, for all the intelligent investors, right, or informed investors, let's put it that way. Over here, and if I'm just looking at this tenure, was a one-time investment better? Was a SIP investment better? Come on, folks. Let's go.
Lump sum. Lump sum and
Lump sum
SIP.
would have been better if I would have put my money.
No. SIP and lump sum both are required, but this time SIP.
Yeah, so that's a very nice addition there, Nakul. So thank you. The point is, it is depending on the timeline, correct? So if I'm only looking at over here, now for this short tenure, an SIP would make better sense because I'm buying my units every time the market's going low, and this is a lifetime high. Is that correct? Now, with that said, because I'm doing an SIP, my recovery over here would have been just about here, depending on how many down market situations I picked up. My recovery, which means I would have been a no loss, no profit situation much sooner than having to wait all the way until this period of time. Is this making sense, everybody? Yes, show of thumbs, please. Thank you very much. Now, this same situation, let's go 2 years backdated. Okay. Does it seem more or less the same? This is COVID drop. We lost 40%. It took us about 9 months time for the markets to recover. If I was doing SIPs for this very short period of time, I would have recovered somewhere over here. Now that I have hindsight information, if I put all my money lump sum in 2020 and I had an SIP as well, when I'm looking at 2021 or let's say 2022, which one would have been a better form of investment, lump sum or SIPs? Quickly, folks. There's no right answer. There is obviously a right answer, but I'm not going to judge you all. So please, by all means, let's be participative.
SIP. Lump sum.
SIP.
For everybody who said SIP, that's a wrong answer. For everybody who said lump sum, thank you very much. That's the right answer. Very simple. Folks, we are at 22,000. This is at 12,000. Okay. 2022 or January 2022, we are at almost 18,000. You're 50% in the game. So as we can see, if you were doing your SIPs, you would have got this rupee cost averaging or bottom fishing rupee cost averaging or buying when the markets are low, getting more units. All of that would make sense only till the time you came to this level. The minute it crossed the previous high or your lump sum level, now you're buying units on the more expensive. Okay. Moral of the story, whenever I'm looking at a complete market cycle, either 5 to 7 years and above, a lump sum 9 out of 10 times will always outperform an SIP. So why do people still feel SIPs are better, or why is there so much, now there is a new campaign about being SIPs or no, whatever that is. Please understand, one is marketing collateral and then one is facts. Okay. So with that said, ladies and gentlemen, now let's say we are in this, so far we had mutual funds, we have PMS and we have AIFs, right? There was nothing in between. Help me understand during this period. Okay. During this period. Now, this could probably go on for another 8 months or 18 months, whatever the story is, which means we're still very volatile. Do we have any opportunity in this short period of time to take advantage of this volatility right now? The answer is no, until the introduction of SIFs. So the reason I sounded like a broken record for some of you, which we've touched upon this time and over again, the reason why this was important to show you from a pictorial representation is to drive the point home. SIF as a product comes in handy during this volatile phases and not necessarily in a sequential uprun. Why? We will get to understanding in just a minute. Okay. Now, over here, give me a second. Let me begin the slideshow. We are here. So as we understood that we only have those 4 options, and now comes SIF. So let's get to the very basics of what SIFs are. Number one, the reason for introduction of SIF, Special Investment Funds, was because for sophisticated investors, sophisticated or rather more informed investors, more affluent investors, more experienced investors, mutual funds as a product was getting very, very limiting. And therefore, they would go about directly jumping to a PMS, which seemed like a better alternative, but not necessarily all of them were a better alternative to mutual funds. Why? We will get to an understanding in just a bit. So SIFs as a product fits in that gap just between mutual funds, PMS, and all the other alternatives at a much smaller ticket size. How much? We'll get to know in just a bit. What's the unique offering? Something that you all have experienced very lately is that we are mostly focused on looking at not a variety of instruments, but the variety of the underlying. How different is the underlying risk when compared to all the other products that we're investing in, right? So the unique offering that SIF has as a product is that it has the opportunity of investing or using derivatives, futures and options. Now, for some of you who are listening at when you're hearing futures and options, you're like, okay, Sharath, why are you getting us through suicide? Because it's generally called the weapons of mass destruction. We will get to that in just a bit. Having said that, this is the most unique offering that we have with SIF, which you can, the fund manager is allowed to have exposure to derivatives, which is futures and options. This is also available in a certain category of mutual funds, namely Balance Advantage Fund, some of these multi-asset funds, and arbitrage funds. This is already there. But in what capacity it differs, we will get to that in just a bit. Okay. Regulatory structure, this is very important. The regulator who manages or who is the watchdog for mutual funds is the same regulator for SIFs, which means it's SEBI. So all of these products, this is not some fancy exotic product. It is a regulated product and it's got humongous amount of guardrails, more or less like mutual funds itself, but a lot of flexibility in terms of what is offered or what options a fund manager can do. But everything is regulated. Your money is protected. It follows pretty much the same structure that an asset management company does. Okay. Who all can invest in this? Everybody. NRIs, residential individuals, companies, trusts, NGOs. Yeah, all of these. So just the similar structure like you have for a mutual fund as well. Your minimum investment, please note, ladies and gentlemen, it's a 10 lakh one-time investment, lump sum. Okay. At the moment, obviously you can make additional investments, but there is no SIPs as such. Minimum ticket size starts at a 10 lakh rupees. Okay. Having said that, these are the basics. We will get to more in-depth conversation as and when we progress through this webinar. Now, very quickly, ladies and gentlemen, the reason I'm going to be sharing our survey results is that this was important. This is to set a context or the tone of a webinar. So all of you guys who responded to this survey, Thank you very much for laying, and a good amount of this webinar, the construct, is completely based on this feedback that I've got. What is a little scary for me, at least as your wealth manager or someone who manages your money, is I've got this 20% of the audience has said, spare me the trouble, tell me where to invest and I will. This is, while it's bragging rights at some day, but given my nature, it is a little too much of responsibility. Then I have 31% of the audience who said, I've heard about it, but don't understand. A good number of people have also said, I've got a brief understanding, but I do not know how to make use of them. The reason I'm sharing these results is, ladies and gentlemen, for whatever questions you have, please do not hesitate. There is no stupid question. There is no silly question. There are questions, right? I'm not going to judge you, and nobody in the audience is also going to judge you. So please, by all means, whatever questions you have pertaining to this instrument, have them documented on the chat box. Okay, that's the reason for sharing this response. And one more time, for those of you who have not, and those of you who are going to listen to the recording and have not participated, please go about participating in these surveys, because it becomes important and it helps me in terms of getting a much better experience from a content standpoint being delivered to you guys. Right now, with that said, question. Some of you would have read this thing, right? 96% or 90% of the audience who participate in futures and options end up losing money. Yes? Anybody read that article from, this is again coming from SEBI or AMFI, one of those, one of those name figures, not some random report.
Yeah,
Okay.
98% was the figure.
Thank you. No, I
Retail
don't think
investors.
it's 98. I think it's
98.
96%, but nonetheless, it's in the 90s. So, the point is, the people who are losing money are not people who are having structures in place. These are not people who are looking at using futures and options from a risk mitigation. Please note, ladies and gentlemen, I said risk mitigation. All derivative options were invented to protect the downside, to add as a risk mitigation, and not to go getting all unleveraged, leverage kind of returns. So most of these courses that you see on the stock market right now, that they will tell you how to buy positions and you can make money with a very, very small component. Again, that's the reason why so many of us are losing. There's no structure to it. Why this was important to note? The reason is because everything that you're going to be doing through the SIF structure has got a format, has got a limitation. How much? We will get to know in just a bit. So, first of all, like I was just saying, just because you're investing in SIF, this does not mean you will get high returns. Okay? What you will certainly get is reduced volatility in your portfolio because of all the risk mitigation strategies that the fund manager will use. Now, this again is 9 out of 10 the case. Sometimes,
Yes.
right. So this is something that we have to note, because I have seen tons and tons of reels. I've seen tons and tons of videos, short videos that are talking about why you should start looking at this, irrespective of how much you've got your money, how much investments you've got, what kind of risk appetite you've got. Please understand, investing in a specialized investment fund has nothing to do with high returns. It can eventually be the case, but how you should look at it is from a reduced volatility to your portfolio. Everybody clear about this? If yes, show of hands, please. Thank you very much. Okay, now that we've got that, let's take a look at the different strategies that we have in SIFs. So one, there is an equity strategy, then there's a debt-oriented strategy, then there's a hybrid strategy. Okay, in the equity strategy, we have three different strategies. Okay, one is an equity long short. See, I'm not going to get into the specifics of this. I'm just letting you know the difference, because obviously we'll have to draw a parallel in comparison to your mutual fund portfolio. Note, you can take a maximum of 25% derivatives. There is a common theme that's going to play out here. Then we have X top 100. Okay, minimum 65% outside the top 100, which means the top largest stocks from as of market cap. Okay, and then again maximum 25% derivatives. Then we have a sectoral rotation, right? I'm going to quickly skim through all of this. We have debt strategies, which is debt long and short. Again, note there is something where we are talking about 25% of the NAV, right, in derivative strategies. And then we have hybrid, which is active asset allocator. And then we have hybrid long short. If y'all were paying attention, can anybody tell me what is the common theme across all these strategies? Quickly.
25% derivatives, generally derivatives.
Thank you very much. Right answer, Nakul. And this is good, right? This is why SIF will not be a weapon of mass destruction, because there is a regulation, there is a structure put by the regulator that an AMC cannot take more than 25% of the portfolio value as a naked call. It simply means if I think, whatever that story is, that tomorrow XYZ company is going to fall down, I cannot take a bet beyond 25 rupees if 100 rupees is my portfolio. Is this making sense? Irrespective of how certain I am, my maximum shorting call or derivative call that I can take will limit to 25%. Is this okay, ladies and gentlemen? Yes, no, maybe? If this is not making sense, no problem. When we get to our one-to-one call, I will explain this more in detail. Okay. But for now, let's understand that there is this 25% is what is going to help us in bringing down the volatility. Okay. Now, let's get back to our chart over here. You see, during this period, during this very, very range-bound period, right? Markets didn't give me any returns. But if I said, from here, if I have okay, we are approaching lifetime high, let me take a call or let me take a position of the market going down. If I did that, I'm not selling my existing portfolio, but I'm taking a call that the market is going to correct. Now, as a fund manager, have I delivered returns? Yes or no? Yes, no, maybe? The answer is yes. Similarly, if I see that, okay, folks, I just need to ask you something. Over the last 3-4 years, we've got almost 3 different times when the market has down by 20%, 20-25%. Is that correct? We all participated in that. There was a proactive message going out to all of you all saying that now is a good time to look at whichever strategy we were looking at that specific market drop. Yes? So someone like Sharath, with absolutely no research team, with no access to Big Four kind of reports, if I can get this, do you think someone as qualified as an institution will be able to get let's say a much better reading of the market? The answer is yes. So let's say at this time they are probably of the opinion that over the next, now this much correction is done, probably now from here there will be a good market. See, I'm using words probability. There is no certainty. Yes. So I will take a position saying that, okay, from now here the market will probably increase, and for this very short period of time the market does increase, I pocket in my gains. Is this making sense? So what SIF allows me to do is, during all of this range bound market, based on certain strategies, it allows me to pocket small gains, which otherwise through a mutual fund portfolio, I couldn't do this. This is very important from a understanding standpoint. So anybody has questions, clarifications, or doubts at this point in time, please voice it out.
Sharath, if I may ask, so why mutual funds cannot? They have their own study, and then they feel that if market is not going to grow, so why can't they? Yeah, why can't they cash in? I'm saying why it is only.
Good question. Very good question. I'm assuming that's funny, right?
Yeah, it's me. Yeah.
So funny. The reason why mutual funds cannot do it is because of the structure and the regulation put in by SEBI.
Okay.
See, SEBI is not concerned about how exotic or how dynamic a fund house can, what strategies they can bring in. They are there to protect the interest of the investor, or more importantly, of the smaller investor.
Okay.
They do not want investors to have Harshad Mehta moment or Ketan Parekh kind of moments. So as many strategies or as many guardrails that can be put in to protect the smaller investor, that is put in place. The idea for someone to get into SIF is basically more experienced you are, more informed you are, Now you can take a little more strategic calls. Was I able to answer that question for you, Funny?
Yeah, got it. So it's basically SEBI restrict them to not to like
That is correct.
the panic sell they don't allow from MF houses.
Not panic sell. Now there are some mutual fund houses, and some of them we've invested in, and for the purpose, because this is going to be a recorded webinar, I don't want to name brands, but we all know that there was few fund houses that were very, very aggressive, and they were churning portfolios too often, and because of one bad move, it erased gains of almost 2, 3, 4 years, depending on the portfolio that we are talking about. So to avoid these kind of very, very random, aggressive, volatile movements is why these guardrails are put in place.
Okay, got it. Thank you.
Okay. All right. Having said that, let's go back to our PPT. Now that we are here, quick question for everybody. Okay. My PPT seems to be loading. All right, so now that we got this, here's a quick parallel to your existing mutual fund framework. An equity long short is more or less like a flexi cap. Then you have all of these different categories. Okay, for those of you who want to take a screenshot, take a screenshot. In any case, you will get this PPT, or we are going to be getting on that one-to-one call. So I will be explaining this in more in detail. I just wanted you to see the similarities between SIFs and mutual funds. Okay. Now, please understand, we are not looking for strategies or uniqueness. We're not looking for strategies, but we're looking to invest basis our goal and the duration of the goal. Very important. We can have multiple different opportunities, but if it's not going to be in line with our with the goal that we're looking at investing for, no point. Right? So the fundamentals don't change. The fundamentals of investing don't change. Now, across all of these options, what is available for us is the 25% derivative positions that we can take. Okay. Having said that, now let's look at returns. For everybody, like I said a little while earlier, we are looking at getting more or less the same returns of a mutual fund. We are not looking at getting humongous 6%, 8%, 9%, 10% difference between an SIF and a mutual fund. The reason we are looking at SIF is to have a much lesser volatile portfolio when compared to a mutual fund. In this due course, over a period of time, if the volatility or the range bound period is much longer, then the returns from the SIF can possibly outperform a 100% equity-based mutual fund, simply because capital protection can be, if you're protecting your money from not falling down, those savings can turn out to be a better alternative when compared to having portfolio to correct and then come back and recover those losses. Okay, so this is very important. Now, I also need you to know the time that a SIF will underperform a 100% equity-oriented mutual fund is during sequential bull runs. I'm giving you the answer. So if you go back to our the chart, right? If you go back to how Nifty had performed. Now, if I look at this period, if I look at from 2020 to let's say 2024, we are talking about a good 125% return on the index. So if I had my money one time invested over here, and I'm looking at this kind of a sequential, I mean, it's like a hockey stick move. I'm telling 9 out of 10 times if the fund has done what it's supposed to be doing, a 100% equity-oriented mutual fund will perform better than a SIF. Anybody would like to tell me why? Now would be a good time. Let's unmute our lines. Let's build in this engagement.
Sharath, Kavita has some question. She has dropped in the chat.
Yeah. So we'll take it towards the end. Questions will take it towards the end. Engagement is now according to this slide.
And this basically there's not so much of volatility during this period.
No.
The 25% derivatives is not part of the equity. So equity will shoot in faster, but the derivative will be the difference between SIF and mutual fund.
Spot on. Very nice, Nakul. So I will just make a slight refinement over there. See, just because I have got derivative options, that doesn't mean I will get it right all the time. Is that correct? So the money that I'm taking for derivative calls, I'm not having that much money exposed into 100% equity. So at a time when I'm seeing the markets going one way up, at that point in time, a 100% equity oriented fund will outperform a SIF, even if it is in the equity strategy. Is this all making sense, ladies and gentlemen? Okay. However, having said that, just because I can get during the shorter periods of time when there's this range bound movement, if my calls go right, that is when an SIF in, again, depends on the fund manager, depends on the number of calls that got hit right, depending on the strategies taken, this will turn out to be a better performance than equity, or sorry, than a 100% equity mutual fund. Okay. So I have another question basis this, and we'll address, we'll take it towards the end because we've got lots to cover, and let's get to the next part of the presentation. Now comes taxation. Okay. Ladies and gentlemen, the good news with the taxation around SIF is because the structure is same like mutual funds, which means you've got capital gains and then you've got marginal taxation. It's the same thing with SIFs as well. So if you're taking hybrid strategies that are debt oriented, then it is marginal taxation. If you're taking strategies that are equity oriented, then it's got capital gain structure. If you don't know about this, no problem. We will address it when we get onto our one-to-one calls. I don't want to address the things that are very, very basic on this webinar. Okay. For all of us, just to make this very, very easy, here's a quick comparison between SIF, mutual funds, PMS, and AIF. Okay. This is a ready reckoner of sort. Please note, ladies and gentlemen, there are different strategies of PMSs. There are different strategies of AIFs. I've given this in comparison to an SIF background. Okay, this is important to note. Now, as you can see, here's your SIF, and this is your minimum investment. In PMS, we are talking about a minimum investment of 50 lakh rupees. Okay, and AIF is, we are talking about 1 crore. Now, in order to again build a two-way conversation, let's say I have 75 lakh rupees. Okay, and my overall portfolio, let's say, is 2 crores. Now I've either sold a property, I've got inheritance, I've got ESOPs, I've got some ESOP maturity, or whatever it is for that matter, right? I've got about 60 lakh rupees, 75 lakh rupees on a 2.5 crore portfolio. Should I consider AIF? Should I consider PMS? Should I consider SIF? I'm not talking mutual funds simply because obviously we are going with the understanding that a good majority of my 2.5 crore portfolio is in mutual funds. Quickly, ladies and gentlemen, if you all were to design your own portfolio, what would you do? Again, no right answer, no wrong answer. This is going to be as per my framework in terms of how I would construct the portfolio. So, like to hear from you guys.
I'll go with the PMS.
Who was that? I'm sorry.
Naveen.
Okay, Naveen, you will go with PMS. Okay, great. Anybody else? Quickly, folks. It's a
PMS, me as well, Bhushan here. Sharath.
Okay. You know what? Let's stop sharing the screen so that I know who is responding to this. Okay. Everybody who is looking for a PMS emoji, thumb icon, or whatever it is, use the chat. Use the emoji icons or in the chat window. Okay. I have Ramkrishna. I have Sunil. I have quickly, folks. Devendra. All of you who got PMS. This is where we are talking about being hyper aggressive. How a PMS is sold out in the market, especially by some of these so-called portfolio evaluation platforms, where they ask you to see how your mutual funds are doing and eventually end up sending a mutual fund, a PMS. This is designed just to give you a red carpet treatment. Okay, 8 out of 10 times, most PMSs will underperform a mutual fund on multiple parameters such as flexibility, such as risk exposure, and taxation. We'll get to that in just a bit. But if I had that same money, if you all were coming to me and saying, Sharath, 60 lakhs, 75 lakhs, what do? We will take a SIF. Why? Because I'm not putting all 50 lakhs with one asset management company. One bad move. Some of you all are invested in one of the PMSs that we've currently got, which is mostly investing in the MSME and the SME space. For those of you who've invested over 2.5 years, you would have seen some bumper returns. And in the last 6 months or 8 months, it has got terribly beaten down. Now imagine if I had all 50 lakhs of my portfolio going in one fund that has that kind of volatility. Vis-a-vis, I had, let's say, 10 lakhs spread across 5 or 6 different SIF schemes with different strategies, with different AMCs, with different fundamentals in terms of how the portfolio is constructed. From a risk standpoint, where am I going to be losing less money? Which is going to be less volatile? Obviously, it's the SIF. Clear? So, as we have always been looking at instruments, whenever you're looking at a lump sum investment, keep the 3x rule in mind. If I do not have at least 3 times the minimum ticket size required for that product, I am not going to be looking at this investment. Again, there are certain times we can bend this rule, but a good rule of thumb, at least how I design portfolios, minimum ticket size. If you do not have 3x of that in liquidity, it's better to avoid that instrument, even though you qualify to invest in that instrument. Is this making sense, ladies and gentlemen? All right. With that said, let's get back to the presentation. Now, the investor type. Okay. The investor type, okay, this is basically how the market defines HNI, retail investors and things of that sort. I'd like to talk from a portfolio standpoint, right? So you start looking at SIF when you have your minimum mutual fund portfolio should be around the 60 to 75 lakh. That's when you start looking at SIF as a category. Again, this is not your lump sum mutual fund portfolio, right? I'm talking about your SIPs. When you build this over a period of time, please don't disturb your compounding. When you got 3 years, 4 years of continuous investments being done in the market, you're just about 2 or 3 years away from one complete market cycle and thereby doubling your money. Doesn't make sense to pull out your money from here and then start looking at something to protect your portfolio. That doesn't make sense. Then HNI, again, over here we are talking about a 1.5 crore portfolio, and here we are talking about 3 crores and above. All right. So these terms are very different. I mean, we are talking about HNI today, someone who's got, let's say, 50 lakhs to invest. Some of us, even in our 30s, have got that kind of portfolio. So that doesn't, at least as per my understanding, doesn't make us ultra HNIs or HNIs for that matter, right? Taxation, very simple. This is as simple as mutual funds. PMS, remember, ladies and gentlemen, at an investor level, we are going to be taxed. So now let me give you a parallel to make these things very simple. In a mutual fund, I have exposure to 30 to 50 different stocks. When the fund manager buys and sells stocks, I am not going to be paying any taxes if I've got any kind of gains. Is this making sense? But in a PMS, because the PMS is only in my name and it's not a pooled account. Therefore, every time a stock is bought or sold, taxation will apply to me as an individual. So if I bought, let's say, a particular stock, I've got 10% gains, I will end up paying short-term or long-term capital gains taxes. Therefore, my net return will be either 10% minus 12.25 or minus 20% depending on long-term and short-term. Is this making sense? And this I'm talking if you're talking 1 or 2 stocks. But remember, when we're talking about 20, 25, 30 different stocks, as and when every time there's a churn on the portfolio for right reasons or wrong reasons, generally, obviously, your portfolio managers will not want to burn or churn your portfolio just because they want to churn. But when they have to make these calls, when they have to make these exits, these taxations will apply to you as an individual and not at a fund level. Is this making sense? Because of this one reason, a PMS has to necessarily outperform a mutual fund that much more harder simply from a taxation angle. Okay. Other things being different, again, there are pros and cons of each of these instruments. But this is beyond the scope of that webinar today. And therefore, we'll move on to the next topic, which is taxation at the fund level. What this section is, we don't need to break our heads, but simply put, every time there is a buy and sell at the fund level, I am not liable to pay taxes. I pay taxes only when I exit from my portfolio as an investor. Clear? Long-term, short-term, or marginal, depending on the strategy that I'm taking. Expense ratio, I've put here 2.25 and 2%, but obviously higher the AUM of the fund, lower will be the expense ratio as per the SEBI's defined slab rate. So it will go as low as 1.05 as per today's numbers that I am aware of. Leverage. Okay. As we can see, there is no leverage available for SIF mutual funds. PMS also, again, depends on what strategies we are getting, but this is definitely allowed in certain categories of AIF. So quick question. If I'm saying there is no leverage, derivatives are giving me leverage. So why am I saying that leverage is not allowed in SIFs? And here I'm saying I can take naked shots up to 25% and 100 hedging. If you all are able to understand this, if you get the answer for this question, you've understood the product in general, at least the structure wise. Anybody? Why is it saying not allowed leverage over here? And here I'm getting to take futures and options. All folks who are investing in the markets, trying your own options, future strategies. Varun, can I put you on the spot? Varun Prasad.
Yeah, I'll give it a go. So I'm assuming you cannot pledge your stocks, get extra money out. That's what you mean by leverage here.
I like the way you're thinking, but it's not the right answer.
Okay. Because naked shots, I am only paying the premium. I'm taking a short or a long call against my up or down. But I thought leverage is like pledging my stocks, getting extra money out to play with it.
So yes and no. And the difference to that will be with this one simple line. I cannot take futures and option calls beyond the 100% capital that I've deployed. Okay. So, in other words, if I've got a 10 lakh rupee investment, my net positions on the futures and options should not exceed my portfolio construct of 10 lakhs and above. Is that making sense?
Understood.
And this is why this rule of, where most traders, most people who are doing futures and options end up losing their capital will not apply in an SIF unless the fund manager does something drastically wrong. Is this making sense, ladies and gentlemen? The most important point here is you will not go take positions beyond the capital invested. So whatever positions you can take will be a offset of the money that you've already invested, and that will also be limited to 25% of the portfolio. Is this making sense, folks? Yes, no, maybe? All right. With that said, by the way, Varun, well done. Very few folks get to this thing because there is a lot of noise and it's not given with a lot of clarity unless you're hearing to these sources from people who are really at the top of folks who are at the senior positions in these AMCs and things of that sort. Because I've heard some of these content which is incorrectly mentioned facts. So that's something that was important for us to note. Now, with that said, now comes the risk asset or things that we have to be absolutely mindful before we set up a portfolio with SIFs. Okay, very quickly, no guarantees, ladies and gentlemen. There is no fixed guaranteed return. It's just like your mutual fund portfolio. You know for a fact, the longer you stay invested, if your fund strategy is good, not excellent, even if you're in the top 25, 30%, there is no way after a good market cycle, you will be standing less than FD returns. This is based on everything from past performance. Okay, can there be really disastrous returns? You never know, and that's the risk we are taking. But basis the last 30 years of mutual fund returns, if you've stayed invested in a fund throughout the journey, if it's 10 years and above, there is no way you lost your money. You might have dismissal returns, but there's no way you're losing your capital. The point is you got to stay invested, and that is something that I want to highlight. If you're coming through an SIF strategy, come in with a minimum 5 years timeline. Yes, on your debt strategy, because it's a shorter tenure and things, yes, you can look at for shorter term goals. But for any of the strategies that you're coming in, including the hybrid, stay put for at least 5 years because you never know which kind of money you will need at what point. And especially for a good majority of you all who are in, the early 50s, late 40s, where we are just about to get into the retirement phase, it would be a good idea to stay in for a longer period of time as against keeping that portfolio only from a mutual fund standpoint and then looking from an SWP stand. We'll be looking at a mix and match, which we will talk again, because that is very personalized and it's very situation based. Therefore, we'll have to take this conversation when we're doing one-to-one. But rule of thumb, no guarantees, stay put in for a minimum 5 years and above. And again, we've already touched upon the minimum 3x rule. Just because you have 10 lakhs to invest, that doesn't mean you're going to be putting your money in an SIF. Okay, a lot of different parameters need to be considered before you put in your money. And obviously, we will take that when we get to our one-to-one discussion. Strategy suitability. Please remember 7 different strategies. See the ones that is going to be suitable according to your end result. If you're looking at this investment to be there for.
Namaste.
if you're looking at having this investment going for 10 years and above, or sorry, for a goal that is 10 years and above, you can absolutely look at the, let's say, a long short strategy that we have, or the top 100. But if you're looking at, let's say, something within the next 5 years or 7 years, then the hybrid strategy could be a good idea. See, again, are you chasing returns? Are you chasing stability? Because each of these strategies have the end result being very, very different. And that is something that we have to be very mindful of before we set up the portfolio. Next, capability and track record. This is something that is very, very important, because there was very recently an asset manager that tried to, recover their lost charm or lost pedigree, whatever you'd like to call. And they went on multiple podcasts talking about, how this is playing to their strengths. And quite frankly, that's the worst performing SIF at the moment, at least when I last checked it. Okay. So just because this feature is available, that doesn't mean all fund managers will be able to strike gold with this. They're going to get this right every now and then. This is something that is very new, and it needs to have a fund management team, a set of capable, fund management team that has shown previous records of being able to do such kind of track records. Okay, that they have been doing this for a while now. They've got a good success rate. The strike rate has been at least 6, 7, if not more. Right. So that is the number that you're looking at. So unlike mutual funds where you're saying, hey, you know what? Okay, this is one flexi cap. That's also another flexi cap. Maximum that would be different is the stock picking. It is not that. There is a lot of different strategies between each of these funds and each of these same strategies across different fund managers. And at this point in time, if I'm not mistaken, there are just 6 AMCs that have come out with SIFs, and not all 7. In fact, I think maximum strategies that have come out is just 2. One is the equity and one is the debt strategy. So let's not go all guns blazing and look at, putting all our monies in 1 or 2 different strategies, because there will be multiple other asset players coming in the future. And then we can see what's the difference, and again, diversify our deployment across different styles of investments. Okay, or different methodologies. Having said that, a few other things that you have to keep in mind are redemptions. Unlike mutual funds, these are not available for daily redemptions. Depending from asset management and depending on the fund, depending on the size, depending on what the fund management house has told, these redemptions could be once a week, once in a fortnight, or whatever it is. So we have to be very mindful of that when we are putting in our money, right? So this is a standout difference between mutual fund and between the logistics of mutual funds and SIFs. Redemptions are not daily redemptions, at least for now. Next, approaching SIFs. Please don't look at it from getting extra returns. Look at it from reducing the volatility in the fund. Okay. Next, monitoring your portfolio. Unfortunately, we do not have platforms there that can give you a comparison between all the different SIFs, because not all SIFs are updating their NAVs on a daily basis. Okay. So yes, these will be available on your mutual fund tracking platform that you're going to be. It's there on a few different platforms, and the one that we are using, which is Investwell for now, that definitely has that tracking ability. We can do these investments online as well, but because this is a much recent category, we still have some logistical challenges, which we'll get to when we actually get to the investing side of things. Portfolio disclosures, as against how it is with mutual funds, which is once a month, is not necessarily once a month. It could be once a quarter. Yet it is completely transparent. You will get the access to the exposure of the portfolio and all of this only towards once a quarter. And that is as we speak. Things could change in the coming months, quarters, whatever that story is. Last but not the least, like we discussed, please don't come to this investment with a shorter timeline. Look at it from a long-term goal. For anything that is less than 5 or 3 years, you're still far better off investing in mutual funds with that specific asset classes, which we will talk as and when we start deploying our portfolios. Okay. The all important question: should you exit your mutual funds? Sharath, I've got 2 crores, I've got 3 crores invested in mutual funds. Should I go about pulling that money out and invest in SIFs? Should I nibble into different SIPs? Different SIFs? What's the answer?
No.
No.
of course not.
How many yeses in the room? I see most of them saying no, so I like to see how many yeses. and again, this is personal preference, but I'm going to be giving you, I'm giving you the pointers basis what I have understood about how this product works. Any yeses in the room? Okay, the answer is right. We are not going to exit unless the portfolio is underperforming, unless the portfolio has not completed beyond 3 or 4 years. Okay, our intention is to diversify the portfolio by bringing down the volatility of the portfolio. Therefore, the only monies that will come out are funds that we've invested in the last 1-2 years that has not gone up, that has not seen too much of movement. We've just seen about 5 or 6% drop in the portfolio. That's the money that we are going to be putting in towards towards building a SIF portfolio. Okay. Yes, if you have additional corpus, again, depending on how long, what's the end result of that money, that's when that portion of the money will get invested. But overall, please remember this one line. SIFs complement a mutual fund portfolio. It doesn't replace it. There are certain standout advantages of a mutual fund, simply, or one of the most common ones being the flexibility that it gives me. I can put in as small amounts of 100, 1,000, 100 SIPs as well, or I can build in additional lump sums of as small as 1,000, 2,000, 5,000 lump sums as well. Again, fund house and strategy. I have different varieties available, which means I can participate in global markets, which currently is not available for me in the SIF. Right? So it is very, very SIF has got its own pros and cons. As mutual funds has got its own pros and cons. We have to see how we can strike balance between the funds. All good so far? Excellent. I'd like to know, folks, from with the changed format that we have today, how, was there, do you all have any feedback for me? I'd like to know, while I'm reading through the questions, it would be nice for me to, get your feedback on how we did this. Was there anything, did this format make sense? Would you like to have something else added while I'm going through the questions so that, I can frame them likewise? You can, sure, please unmute. Please unmute. Don't type in the chat box right now, because that way I have lesser things to go through.
Hey, Sharath, quick
Yes.
question.
Yes,
Raju here. While we are building the SIF portfolio, do you suggest to reduce the mutual fund set portfolio?
Okay.
Monthly
Question
SIP.
is, the question that you've asked is more or less the same, but I like the angle that you're playing. So now you're saying, should I bring down my SIP contribution and then build liquidity to part in SIP? So in SIFs, correct?
Yeah.
Okay. This is very, very situational and very personal. For example, let's say I don't have a large portfolio and I'm only building my portfolio via SIPs. Like pretty much like how we began our engagement. You didn't have a large mutual fund portfolio and you started investing in the market only through the SIPs. Having said that, you will not bring down your SIP input. You will go about building your SIP through the mutual fund portfolio itself. Making sense? Because you want to build large enough a portfolio and not have, just because now you got 10 lakhs, then put your money in SIF. This is one vertical. Second category is the majority of my audience, where you'll come with a large amount of portfolio and then you're doing substantial increase in SIPs. Okay, let's understand the advantage of an SIP is to help you build a system through a disciplined approach of building large amount of corpus. Okay, you may reduce the SIP depending on the SIP amount that you're putting in. So let's say if you're putting, 1 lakh rupees, and then you had a choice of because of increase in income, because of whatever, you bought down your loans or whatever. Now you can go about putting 2 lakh rupees. Then in that case, we could say, let's bring down the SIP amount. Let's keep it to 1 lakh. Instead of putting an extra 1 lakh rupees in SIPs itself, we can possibly look at building the liquidity. But again, now you're talking only if it is SIPs and SIFs. But if you had other alternatives, then it makes better sense to build a larger corpus to participate in other instruments that we're going to bring in. Right? But if you're talking 1 lakh to 1 lakh 20 doesn't even make a dent, please continue increasing your SIPs. Build your mutual fund portfolio likewise. Is that making sense? Now, the last category, which is you got only lump sum investments in mutual funds and no SIP investments. Then in that case, depending on how long this portfolio is going to be there for, we can skim some of this portfolio, provided there is an overlap between all the other funds. Like I have some of my families, when they come to me for the very first time, they've got, let's say, 10 lakhs or 20 lakhs in one flexi cap, and then they've got another 10 lakhs and 20 lakhs in another flexi cap. There is hardly any diversification. Prior to this, what I would do, I would probably move this to another thematic fund. But now, instead of moving it back to a thematic fund, I would probably consider the SIF. Is that making sense, Raju? Was I able to answer this question?
Got it. I think
Exactly.
it's not
So
one
again,
answer.
there is no one size fits all. It depends, which means we will have to start talking. We'll have to understand why, what, how long, all of those different things. Excellent. Any other questions, folks? Okay. Kavita is asking, in what way are SIFs and mutual funds comparable? Sorry, basic questions in terms of returns, in terms of risk, in terms of lock-in period. I'm assuming, Kavita, this is something that we've already covered. Is there anything in specific that you think you'd like more clarity on?
No, I think we did cover that. Only thing I wanted to understand is that my next question related to it looks like it is like a mutual fund with a high risk kind of investment strategy, mostly thematic or
Not
short term,
really.
small
No,
cap,
Kavita.
something like that.
No, Kavita. In fact, SIFs are more or rather less volatile. See, when we're talking about risk, I sound like a broken record when it is not risky, it is more volatile. Correct? How is volatility managed? By taking certain hedging strategies. Let's talk about arbitrage. From the time that you've been an investor, have you seen any time negative returns in arbitrage over a 1 year, 2 year period of time? The answer is no. Okay, why? Why don't you see a negative return in an arbitrage, even though the underlying is equity and it's not debt-based investments? Because the fund manager is trying to take an advantage of two different markets, which means I'm buying in the cash market today and I see a disparity in the futures market. Either the futures market, the price is low or the price is high. I'm trying to do an average, but I'm not taking guesswork. I'm balancing out. Today I'm taking a buy call or a short call, and tomorrow I'm balancing it out with a sell call or a buy call. So there are never naked positions being taken. It's a little technical, but why I want to highlight, these are strategies for risk mitigation and not chasing higher returns. Bringing down the risk or bringing down the volatility, and if the call goes right, more often than not, and depending on how many volatile situations like this we have, that is what will give the additional return to the portfolio. So to answer this very, very shortly or in very brief, it is not riskier. It is much more, or rather it's less volatile when compared to a 100% equity oriented mutual fund.
Okay.
Sharath, just to clarify,
yes.
So
Naveen, please
SIF
share your video on here. It's okay, irrespective of where you are, and I'm assuming you're still in you are being hotel, you are in the hotel itself. Yeah, there you are. I guess right. Yeah.
So I'm saying, so SIF, basically the 25% which they're going to, which they can invest in derivatives, then that is mostly just shorts, because
That is
otherwise the
covered calls.
75% is any which way is long, right? So if you're saying they're hedging it, then mostly it will be shorts.
It will be shorts, or it will be covered calls also, and those will be naked positions, but never over and above the 100% of the capital being invested.
Yeah, okay.
So which means my total position exposure will be no more than 25% of my invested portfolio.
Okay, got
Making
it.
sense?
Yeah.
Excellent. Now, Naveen, I'm sure you are able to appreciate how this is very, very different from the trading and futures and trading calls that most people take, because they are generally naked positions with no money. We are trying to take calls basis on hunch and not necessarily research. Okay.
Sharath, what
Now,
is the return expectation over 5 to 7 years?
Anybody in the audience would like to answer that question?
Same as mutual funds.
More or less like mutual funds with lesser volatility. Even though that is not what is propagated on the media, I'd like to look at it from that angle. So from an expectation setting standpoint, please keep the similar kind of returns of mutual funds with lesser volatility. If you get better returns, fantastic. As all of you already know, I like to under-promise and over-deliver. I don't want to have this thing sourced because it's giving you higher returns. Okay. So did that answer the question, Sridhar?
Yeah.
Excellent. Nirupama is asking how old is SIF, and I'm trying to understand the historical performance. Good question, Nirupama. To answer that, it's very simple. SIF as a category was introduced just about 16 or 18 months back, less than 2 years. Okay, so there is not too much of past performance, right? Again, like I said, there are just about 10 or 12 different funds, 10 or 12 different strategies across 5 or 6 different AMCs that have come up with this. So past performance is no measure for what is going to happen in the future. But if you understand how this is different, more or less, it's the similar kind of what it helps us is in terms of a unique offering which we do not have exposure to in mutual funds. That's the reason we are doing this. From a return standpoint, if you look at it, 25% lesser volatility into your portfolio if the fund manager gets it right. When we decide where we want to invest, I will get one-to-one and tell you why am I recommending this particular fund when compared to anybody else that's there in the market. Did that answer the question, Nupam? Okay, thank you. Next, Kavita has gone. Okay, it's the same question. No. All right, not too many questions in the chat box. Have I? Is there anything else, ladies and gentlemen, that you would like to ask?
I have a question.
Okay, sorry. Who is this?
Girish.
Yeah, go ahead, Girish.
You said minimum investment in this is 10 lakh, but once we start it, is it possible to invest whenever we want to invest? So 2 lakhs, 4 lakhs, or 5 lakhs?
Absolutely. And if it's possible as well, Girish, I would not want you to do that in one AMC. I want you to build a little bit of corpus and start taking another AMC's alternative.
And you said it is better for volatile kind of situation. So whenever market is volatile, is that the right time to put some money in this, or and how quickly it gets invested?
Not say right time, see, because now we are looking at timing the market, right? Now, again, when you'll read my emails, when I'm talking about the index fallen down by, let's say 25%, 27%, I don't say this is the right time. What do I say? This is a favorable time, right? So building on your question, SIF is not the right timing. It's not the timing of the product. It's just a diversification into your portfolio to handle situations that are very volatile or range bound in nature. Mutual funds as a product does not. In fact, most PMSs also don't allow you to participate from range bound markets. What are the promises that most PMSs do? They tell you that our fund picking style is good. We do an in-depth amount of research, or we are a micro cap strategy, or whatever it is. Each of these strategies rely on stock picking, not necessarily taking advantage of a range bound market. Is this making sense? So look at what has happened, right? On Thursday, the market recovered 1%. On Friday, we are down by 1%, more or less. Right? So during these times, these covered call strategies, these different strategies that are there in SIF allows us to participate because of 1 month, 15 days, 20 days, 30 days, 60 days situations, or these volatile or these range bound movements, to participate and get profits into the account. Now, only thing that matters is how many calls will go right, because as always, just like how we are doing our mutual fund, why are we doing a 10 fund exposure? Because at certain times, for all of you on this call, if you look at your Kotak manufacturing fund, just about 6 months back, it was one of the worst performing funds in your portfolio. But now if you look at it over the last year and a half, it has been the best performing fund, or rather one of the top performing. Why? Because we are playing sectors, because we are playing themes. So at any point in time, when you look at your portfolio, now just like I said, if you started in 2020, and if you looked at 2020, 2022, 2021, your mutual funds will be outperforming the SIF. Correct? But now when you're looking at the same portfolio from 2021 to 2023, now an SIF will start to be better. So what is the common theme here is your tenure that you're looking at. And if you're an investor who's looking at a 10-year, 15-year, 20-year investment cycle, right? I'm not talking about continuous addition of funds. I'm talking about staying invested. So if it's a 20-year, 25-year, 30-year kind of a horizon, then it makes sense to have this predominantly for a diversification. So it's not either this or either that. It's a good combination for both of them, depending again on certain stages and your requirement on the liquidity and so on and so forth. Sorry, long answer to a very short question, but it required that kind of clarification.
Yeah. Thank you so much, sir. Got it.
Super. Raju, I think you had raised your hand.
I have a question.
Yes, please.
One of the previous question on that. What is the fundamental difference between mutual fund to this SIF? So other than the volatility, which you mentioned that can be addressed to the hedging, but also you mentioned that you have opportunity to participate in the global funds.
That is in mutual funds, not in SIFs at the moment.
Oh, okay.
At the moment, from the schemes that I have looked at, I do not know of anyone that is participating in global markets.
Okay. Okay. If that's not, then your exposure difference primary is you can only leverage 25% of the what SIP you put, right, in a SIF. Remaining
25% of your
75%.
investment portfolio. That is correct. And
Remaining
sometimes that 25% is good enough.
Okay. Remaining
Sometimes the
75%.
25% is good. Sorry,
Yeah,
I think there's a lag, Raju. Please continue. You complete.
Follow-up question. On remaining 75%, what else you have opportunity other than the mutual fund when the markets are volatile?
Oh, so they will see, as we already know, mutual funds, underlying assets, you're investing in stocks, or depending on which category of mutual fund you've taken. If you've taken a multi-asset, then what is the underlying asset? Equity, debt, arbitrage, REITs, InvITs, global assets, so on and so forth. Is this making sense?
Yeah.
What allocation goes to each of them is dependent on the fund manager. Okay. Similarly, in SIF, 25% I can go and take derivative calls. What will I do with the remaining 75% depends on the which strategy of the SIF I'm looking at.
Yeah. Got it. And the differentiator is the 25% because every fund has their own strategy and
Yes.
theme. Right.
Yes. So my idea is, see, today when you started your portfolio, Raju, I'll use your example itself, right? When your portfolio was small, when it was the under 1 crore number, it didn't hurt you much. But now when the portfolio has gone in the couple of crores, right, and little more, right, every small volatility is hurting the portfolio. Now, if I can bring down that volatility, does that matter quite a bit for you? The answer is absolutely yes. So mainly SIF is going to be mostly appreciated by people who have seen suddenly when their portfolio is a 4 crore, 5 crore exposure, and then suddenly when there's a 1 month drop, imagine the March or the February of 2025, the index was down 20%. So if I had a 5 crore portfolio, for no fault of Sharath, for no fault of the investor, and no fault of the market, notional loss of 1 crore. But of that 1 crore, if I can save notionally 25%, now suddenly I've saved an extra 25 lakhs. Making sense?
Yeah.
So because I'm introducing this predominantly from most of you all are going to have a 5 crore, 10 crore portfolio with your ESOPs, with your EPF money coming in with the time of retirement and things of that sort. So we'd like to get accustomed towards having an allocation towards SIF is where I'm getting at. Making sense? Super. All right. I have a few more things. Kiran is asking, hi Sharath, need to drop off. Can drop off. Any other questions, ladies and gentlemen? For all the folks who have already heard about SIF and you probably like to have a contrarian view, any questions from all the experienced or rather well-informed investors?
Shad Ganesh had a question. I think he raised hand.
Ganesh, are you on call?
Yes, Sharath. Sorry, I had
Ganesh,
some.
before the question, please unmute. Please share your video.
Yes.
Thank
Okay.
you.
See, I am in such a stage wherein the investment horizon is going to be for a shorter, say, period. Next 3 years, let's say. Okay.
Right.
With whatever the mutual fund portfolio that I have built up. Okay. If I'm looking at, say, taking a cover from volatility. Okay. Is that SIF is a good option, or that's what is my main question, okay? Because I'm just looking at next 3 years, let's say, because I will not be able to stay longer in this particular, say, investment.
Incorrect, Ganesh, and I'll tell you which aspect we've not understood, or rather, where the differentiation is not clear. Let's understand something. Forget whether it's SIF, mutual funds, or whatever it is. Now, there are two stages. One is at the stage when you're earning, which means wealth accumulation. And one is the stage when you're wealth distribution, which means now you're starting to pull out money, all that compounding and everything, you are starting to withdrawing money from your corpus. Is this clear?
Correct.
Irrespective of the instrument. Ultimately, you either have money for your retirement or you do not have money for your retirement. Is this clear?
Correct.
Now, during the stage, in fact, you're already at that stage because you're pulling out money for your kids' education, you're pulling out money for higher education, you're looking at, whatever. There is money starting to go out. Therefore, from a investment strategy standpoint, you have to be you have to put this money to better use. Whether you put your money in debt or you put your money in equity, you have to stay invested in one asset class. Is that correct? Okay. Whether you put your money in debt or you put your money in equity, there are different instruments. Okay. As we have already been to this during our previous call, I've mentioned that we will be using the SWP strategy and therefore not follow this random guidelines that or rule of thumb that says, okay, now you have to move all your money from equity and move it to debt. Because the biggest problem with debt-based investments is taxation. You get taxed at the 30% tax bracket. Okay. Depending, again, what kind of income is coming in and so on and so forth. Therefore, if you're looking at a balanced strategy, you will look at some portion in debt, some portion in equity. Is this correct? Correct. Now, as we already know, mutual funds as an instrument can solve for the requirement of debt, can solve for the requirement of equity as well. Most of us think of mutual funds only as an equity thing that money is exposed to the market. No, it depends on which asset class of the mutual funds that we are putting our monies in. Clear so far? Yes. So now we have mutual funds also having debt options, mutual funds also having equity options, and mutual fund also having hybrid options. SIFs also have the same thing. Okay. So now to answer your question in a very simple one line, you should have a balanced exposure to equity, to SIFs as compared to mutual funds as well. Equity or debt depends on your risk, depends on your comfort level with how much volatility you want to handle. Okay. Is this making sense? Yeah. Okay. So it has nothing to do whether how many years of income you have to earn, because you are going to stay invested. You need the money to work for you. No? Correct. Unless you're saying, Sharath, I do not want to do anything with the market. I'm happy with an FD, even though it gives me negative inflation returns. I'm okay. And that's a choice that you will take as an investor. But I know my families, 100% of them will stay invested in one form or the other. Right? So you got to start looking at debt or equity and not necessarily product. Good. Okay. So far? Okay. Excellent. Any other questions at all? Ladies and gentlemen? Okay, Vikrant, you've asked me a question. Is there a chance for the minimum investment to reduce? I don't think so, Vikrant. Actually, I don't have any connections to the inside information and things. But the way how they have done this is they're keeping this at a minimum 10 lakhs for reasons so that, for all these strategies that they're taking, it requires that, it requires that kind of minimum capital that's required. So I don't see this coming down below 10 lakhs anytime soon. But if it does, you all will be the first to know. When I know, y'all will get to know as well. So that is that. Anything else, ladies and gentlemen? All right, then, folks, thank you very much for being a part of today's webinar. I hope this was quite useful. We've completed in record 75-minute time for a very, very exhaustive product. So I'm thinking this format is working out. And thank you again for all of you who've taken the survey. This helped me in terms of structuring the content really well and giving all, visual explanation as compared to just giving gyan over gyan. And this helps. So for those of you who have not taken up the survey results for all the upcoming webinars, please participate, give feedback, and I would love to hear from you all whoever answered, whoever have been a part of this webinar, and those of you who are going to listen to the recording, please share feedback, because then, I want to concise, I want to make this even more informative. And the few changes that we are planning to do, which I will let you all know as and when we have our individual calls as well. With that said, enjoy your weekend. Have a lovely one. We'll talk to you guys very soon. And if you all have questions or anything, we can drop them in our personal WhatsApp groups as well. All right. Have a lovely weekend, folks. Take care then. Bye-bye.
Thank you. Bye, Sharath.
Thank you, Sharath.
Take care.
Thank you, Sharath.
You're welcome. All right, folks. I'm dropping. Thank you very much.